Happy Friday.
Hey, how you doing? Good to see you.
We didn't meet last week, so we threw off the YouTube algorithms big time. So
I imagine we did.
It was Easter Sunday. I got to show you something here. My brother sent it to me from Port Angeles. One of their friends filmed this down by the ferry dock, and there's orcas, killer whales. They're never there.
Oh, wow. Wow.
They usually don't come into the harbor that close.
Wow.
These people sitting in a restaurant watching this.
Even they're looking for a home.
Yeah, that's right. Yeah, there are only 3 homes for sale in that town today. So my brother's been tracking it. So pretty interesting. So want to remind everybody that the purpose of this channel, we are not economists, although Pat's pretty darn close. And I'm just a real estate agent, but we don't make bold, wild guesses on where real estate's going to be in a couple of years. What we're trying to do is look at the numbers every week and say, okay, what were we expecting to see change? What kind of changes out there that might indicate something's about to shift? And, we've been seeing things actually stay relatively the same with little subtle differences, right, Pat?
Yep, very.
It's kind of like going on a boring date when you join us. So.
Yeah, that's the thing. I know. I think for the last year, it just seems like nothing's changed. And once again, it's like watching a football game. Just watching the whole first, second, third quarter, and then finally you know what the whole game is all about if you watch the whole game.
Well, there is a decrease in buyer traffic, and I'm going to show it on this chart here. I'm going to make it a little bit bigger. And, it's that 7-day moving average that I track. But I want to caution everybody that the difference that we're seeing right now is simply due to the holiday, for Easter. So there wasn't as much traffic, but when the numbers are this tiny, it doesn't take much to tweak them, right?
Well, that's the thing. That's the thing. The number's been so tiny that, we see something happen. Obviously the trend's going to start. We're going to see the trend start to develop.
Yeah, we have 4,700 listings on the market today, which is higher than last week. But you can see 7-day moving average, the number of homes coming on the market outpaced the number of homes that went under contract by about 380 homes. I'd love to see that happen every week, but I know it's not going to. So this coming Monday, when I do the 7-day moving average, it's going to remove Easter weekend. And then we'll be able to get a closer look at that. So I think that's going to be something to take a peek at. The Cromford Market Index, the CMI, those numbers are turning red, but they're not turning red because we're getting more listings. They're turning red because we have buyer fatigue and we're seeing less and less buying activity. But they said there is still almost no sign of supply increasing. Incoming new listings are down compared with 2020, both for the year to date and for the quarter to date. The slight decline in demand that has caused the CMIs to fall from their all-time peaks is not going to be enough to take them lower unless supply cooperates by trending higher. And we're not seeing that yet. So I took a look, and this is an area I was searching earlier in the week, and we've got 24 listings in that area right now, and that's a pretty significant bump considering what we were seeing just the other day. And if you look at this list, there's a new listing over there. There's a new listing. There's a new listing. This one's 594 in Chandler. Let's see how big it is. It is 2690 square feet. Not a bad place. That's probably Hamilton High School. So there were some good ones that came up this week. So if you're looking this weekend, there's some choices, more choices this weekend than there were last weekend in that price range. Now, one of the things that we were looking for is any changes in numbers and listings because of forbearance. The forbearance plans are ending, and that's going to be when all of the foreclosures show up. So some say.
Yeah.
So we can decide that yes, that's probably going to happen, or no, that's probably not going to happen, and share numbers and stuff. But this right now is an opportunity to look at what's going on with forbearance, because at the end of March, that was when the first wave of homes that signed into the forbearance program expired. So right now, we should be seeing the effects of that, and we're not seeing it in our inventory numbers. So if we were truly going to get a bunch of, and maybe they're going to wait a few weeks, but what we're seeing is, according to Black Knight, the number of loans in forbearance programs declined last week for the 6th straight time. So they're exiting their forbearance plan. As of April 6th, the number of loans in active plans was 2.3 million, or 4.4% of all homeowners with mortgages. This was down by 228,000 from the previous Tuesday, a 9% drop in a single week. That's pretty good news.
Mm-hmm. Yeah, the lenders are definitely, they know what's ahead of them. And I think, like you and I were talking about, they're preparing, the servicers for, like, what can we do? And it's going to be more of a control. It seems like it's going to be more control, because back in 07, 08, things just started nosediving quick. And quite honestly, we're ready. I think lenders and servicers are going to be ready for the if there is an onslaught, because in 07, 08, they did not, it just was an avalanche.
Well, in 07, 08, I mean, there was already too many homes on the market. So anything additionally that got put on there just couldn't get absorbed. There were too many, way too many. I wish I could find a chart here, see if I could find it, but I won't take the time during this to do it. So I might bump into it in a minute. But so the CF, you're seeing a lot of YouTube chatter going on right now, and some of it's very accusatory, saying, now there's another mortgage bailout. They're postponing the inevitable, kicking the can down the road. What did the CFPB do this week, Pat? What did they say?
Well, they basically said, we're going to work with you guys, right? I mean, I don't know if that's right. We're going to make it. We're going to work hand in hand with the servicers to make it so we don't see this avalanche. In a nutshell.
Well, and they also issued a warning to servicers saying, look, there's going to be more and more of these forbearance, ending, and they're going to need to come out of their forbearance, and you guys need to get ready to handle that volume. So you need to be prepared. I don't need to ramp up with staff or systems or whatever, but you need to be prepared. And we want you to give them time. They don't want you to pull the trigger on foreclosure right away. They want to give you time. So they extended it to
2022.
So they didn't really kick the can down the road, did they?
No, not really. They're just kind of setting up the whole game plan so people can ease. There's going to be easing out, and people got equity. They can sell. It's pretty simple.
Yeah, so they're saying, we want to give you some more time to work through this, because when the crisis came last time, we couldn't even find, you guys couldn't find who even owned that note anymore.
People were, it was a scrambling around. I mean, everybody was just it seemed like for a year and a half, people were just, nobody was ready for it. And that just snowballed. It kept snowballing, and just the ball kept getting bigger and bigger and bigger. And this has been more controlled. I mean, if you think about it, they didn't have this plan, this forbearance plan back in 07, 08. They didn't have, like, hey, we'll put you, they were doing it. Everything was back in 07, 08. Everything was being done on the fly. Everything.
It probably didn't have, there's so much money out there right now too. I mean, there's trillions of dollars of people waiting on the wings for foreclosures, just waiting, chomping at the bit. And that's we used to hear of the shadow market.
Yep.
Back, the homes that were all of a sudden going to hit the market, the shadow market. I think there's shadow investors out there right now.
Yeah.
There are, and again, we're not making bold predictions, just kind of trying to guess, because what kind of numbers would we look for going forward? And as we see these forbearance numbers decline, we need to immediately see if they exit their forbearance plan now. Are they putting their house up for sale? So in the next couple of weeks, are we going to see any uptick, or did they just exit the forbearance plan? They're staying put because they can afford the payment. Because one of the things that they're offering you guys is you can reset their loan to a 40-year note.
Mm-hmm. Yeah, exactly.
Are you seeing more 40-year products out
There's
there?
talk about it. There's one lender that came out with a 40-year a couple months ago, and that was it. NewFi. One thing I did see something that the government can certainly do some things to affect this. I mean, I saw one interesting thing that government policy could actually help, where they could actually change the capital gains if they want to loosen up the supply. This is not talking about forbearances, but loosening up the supply, because there's a couple of things I'm going to hit on real quick that maybe I'm just like we said, we're throwing key points out there for people to think about, and not some crazy theory. But one thing I saw is that they could maybe waive a capital gains on a primary residence, say for seniors to sell their home, because I think a lot of seniors, have been stuck in their home because of COVID. These are just things that you and I talk about and I read about, and I'm like, that makes a lot of sense. Just digging into this information, but they could ease the capital gains on if you had a home, make it more attractive for people to sell their home. So they got it, because bottom line is we have an inventory problem, and this inventory problem is not going away.
Well, what it scares me is the current administration is acting like we have a qualification problem.
Yeah. That's what the $15,000 credit is, a qualification problem. That's not the case.
Yeah, we have an inventory problem, and they this current administration has not indicated that they have seen one tax that they want to lower. So that concerns me. Yeah,
exactly. One thing that I was talking to a buddy of mine, and he's stuck in this right now. He's got 3 rental homes, and he's doing fine, financially, but he's got this one renter that has been not paying rent this last year. And, he's got 3 homes. He's got money in the bank. He's able to, wait this thing out. But it's going to be interesting to see, if, we're going to see some private investors that basically, have got, the mom and pop investor that own 1 or 2 rentals that they use this to pay the mortgage. There could be some supply there, because it's interesting. I read this. There was the single home and condos that were converted to rental units in 2015. It said there's one economist that said that there was 17.5 million renter occupied single family homes in the U.S. 17.5 million, up from 10.7 million in 2000. And they said many of these homes were purchased by investors, and that obviously hurt the supply too. And I was talking to another real estate agent this last week, and she said that there's still investors going in and buying, because I think they're kind of doing they're playing the momentum game.
Well, it makes sense that investors are out there buying, because they're probably seeing some opportunities, because you've got some investors that already bought back in 2010 to 2012, and they've got good return on investment, and they've had really good cash flow, but they have the possibility that a higher tax rate's about to hit them in the side of the head. And so maybe they're thinking, well, once I get this renter out, I'm just going to part with this and take my profits at a time when I can keep it. But you've still got the other investors going, oh, well, here, I'll take it over.
Mm-hmm.
But I don't think investors are going to sell their homes to other investors when they want out, because they know that the retail market's strong enough. They'll get more money.
Yeah.
So I'm not going to sell my home to you because I know you're an investor and you want a lower price for my home. I'm just going to put it on the MLS.
Yeah, retail's going to pay more than an investor, no doubt about it. And that's been the frustrating thing on my end, is just seeing these poor people that the VA. I think I've talked to you about it. I mean, I've been frustrated talking to other agents where people are basically, the VA buyer and the FHA buyer are getting pushed out, and especially the VA buyer. I feel bad because I feel like they owe, they paid a debt to our country, and they should deserve a home, and they're getting pushed out on these offers.
What's the main reason for pushing them out? What's their excuse?
Well, the listing agents are basically, discouraging the sellers to say, hey, it's over the cash, the cash buyer over the VA, and they're saying they're thinking in their mind that there might be an issue with, appraisal, because VA is a little bit tighter. They watch out for the veteran, if the property is livable, and the seller has to pay. They can't pay certain HOA fees. The VA does watch out for the veterans in certain areas, but which restricts the the listing agent or the seller. But it's these the listing agents telling these sellers, we got 10 cash offers, we got this VA. Let's take look at the cash. It's almost like discriminatory. In my point,
there's really the fees aren't that much to where the seller needs to worry about it, because as a seller's as a buyer's agent on a VA loan, I would say tell me what those fees are and I'll cover it. The veteran can't cover certain fees. I get that, but I can cover it with a buyer credit.
Yeah, and it's not that much. Sometimes the term, just certain fees. It's not like it's tens of thousands of dollars. But like I said, a lot of agents, I think, have this built up perception of VA, the VA appraisal. Obviously, if it comes in lower, they get the tidewater. They're alerted that it's coming lower than the purchase price. But the VA, the veteran can pay, make up the difference in the purchase price and the offer price, the appraised value. So that's never been a problem. But like I said, to go back to that moratorium, my buddy, he's getting stuck with this lady that's hasn't paid rent for the last year, and he said, you think about it. Obviously, I think we talked about it, but people that own investment properties, that the mom and pop that own one or two or three, they really can't sell those because, if you got a squatter that's sitting in the house, they can't kick them out. They can't. I mean, I've seen that kind of pop up on the on information I'm looking at is you got this person that's renting. They might have signed a lease till 2022, and you can't do anything about it. So you're not going to have a retail person buy an investment property until things, this moratorium goes away too.
Yeah, that's the thing. Just because a moratorium goes away, doesn't mean that all of a sudden there's going to be this inventory and wave of houses hit, because there's still going to be some steps that need to be taken to get those renters out. Now, they might have a lease that says till 2022, but if they didn't pay their rent, then are they going to say they violated the terms of the lease when it was the CDC that came in and said, right?
Yeah.
And then when you sell a rental house, somebody else buys it, the person that's renting that has in their contract a thing called the period of quiet enjoyment. And what that means is you have a lease and it's your lease. So and I'm renting from you, Pat, and you sold that home to somebody else, my lease doesn't change. That's what the period of quiet enjoyment means. It doesn't mean we promise your neighbors won't be noisy. So that's something that's in every lease agreement. So that keeps you from worrying about somebody selling it out from underneath you to a new landlord and he comes in and jacks up your rent. So I think going back to appraisals for a second, what are you hearing and what are people doing? Is there anything creative going on to close the appraisal gap? Because appraisal gap is what everybody's doing right now, or they're waiving appraisals. They're filling out that waive appraisal form, and it's just, you've really got to do some math and calculate your risk before you try to buy a house doing that. Because, if there's a whole bunch of people that bid the house up $40,000 over asking price, that doesn't always mean that the appraiser is going to match that $40,000 gap. So what are you hearing? Any tricks?
To be honest, the honest answer, I haven't heard too much, really. I mean, people are just paying the gap. If obviously you put 20% or lower, you might be able to get a property inspection waiver. A recent deal, I wasn't able to get a property inspection waiver because it was a second home. The DULP, the Fannie Mae Freddie Mac system, basically they tell you whether you get an appraisal waiver or not. And some people say, well, my bank, I'm sure I'll get an appraisal waiver at my bank. Well, basically it's a system-wide thing that we just run the information in the computer system and it says, yes, this property does qualify for a property inspection waiver. And basically it's data in Fannie Mae and Freddie Mac, all this historical data that they have on the neighborhood. So if it's a new community, they might not have as much data. But I haven't really, my honest answer is I haven't seen anything creative. I haven't really seen it. I wish I had some bombshell, but just getting the property inspection, the waiver. And once again, you have to go back to historical numbers. If you bought a $400,000 house and you paid $40,000 over, at 4% per year, you're going to be back to 440. Like you said, we talked a couple of times the last couple of weeks. Right now, you're paying, for future appreciation. And once again, the demand everything that I'm seeing, we're going to be in this for a while. This supply demand situation.
Yeah, using your example right there of a $400,000 house that you paid $440 for it, we're going up at a 10% clip per quarter right now. 10. Yeah. And so in 12 weeks, it's $440. Now, that's easy to predict now because of our inventory situation. So when I saw people get caught up in this back in the last thing, and realtors were looking them in the eye going, well, congratulations, you already have $40,000 in equity. Be careful with that. I mean, you do, in fact, on paper, based on today's trends, that may be true, but don't take that in the bank that it's always going to be that way because that's the way it was the day you bought it. That was something, when before my mom passed away, we were going to, try and sell her house, and she could not wrap her head around the fact that it was only worth $225,000, but they paid $350. And I'm going, Mom, we had a major economic crisis, but we paid $350. And, sometimes people don't, it's not fair. But I don't see that coming down the road. And I mean, here's the history of our foreclosures right here. Yeah. Look at this down here. The blue line is trustee sales, and this is notice a trustee sale in the red line. They're all redlined at 0. Mm-hmm. Yeah, there's a long way to go to get there to where we're having a bunch of foreclosures. And if you've been out there waiting, people are waiting. And I just, I mean, you get all these people, these saying we're going to the crash. Like you said, once again, they have a reference point back in 07, 08. People have to realize that they have to stop, if they do right now, you have to kind of say, okay, what I think people are kind of coming to a realization of what market we're in. And I know it's easier said than done, but, if you have to right now, if you're in a position where you have to buy something because you're moving, you got to try to be creative how you can get the money to, obviously maybe get a gift from mom and dad or, maybe obviously borrow from your 401k, but, it is what it is. People can, what I see a lot of times is in my business, people say, well, it should be this way, because, a scenario should be like this. And people just have to catch up. I think people have to catch up to reality. The reality is we got the supply and demand equation that's really off kilter, and they just have to come to that realization, and just kind of learn how to live with it. And people get caught up. I mean, I just thought about this the other night, just driving along. People got to stop and realize that, okay, yeah, are you overpaying right now? $400,000 house, you say have to pay $425 or $430, but the way the market's been going, like you said, probably the next 12 to 18 months, it'll probably be worth $440. But the point I'm going to make is it's not like the stock. People are, I think, in the back of my mind and in the back of other people's minds, I think people have a tendency to equate stocks, real estate like stocks, and that asset. People have to stop and realize you get utility out of buying a house. You're not just buying an asset, but you're getting utility. You're actually living in that house. You don't live in stocks. And your payment sticks.
Yeah, your payment sticks. You're not getting it raised every $100 every year when you're renting. But once again, it goes back to utility. You're getting some utility out of that asset versus a stock that you're buying at 40 and, a stock that's at 4, because basically right now what people are doing, let's say stock at 10, but you're actually paying 14 for it. But you don't get any utility out of that during that time but you are getting utility. You're living in it. You get tax deduction, and you got a place to live. So there is utility in the asset of a home, and I think people have to stop and realize that. Does that make sense?
I want to address Brandon's comment here. You see, he tried $7,000 over appraisal up to $15,000 over listing, and it didn't fly with the seller. So it sounds like the seller wanted that entire $15K covered instead of just $7,000.
Yeah.
And I'm seeing a ton of that. People are just coming in and going, "Oh, I'll cover the difference." And sometimes that math works and it's great. And we wrote one, last week and said, okay, I just sent him an Excel sheet and said, here, you play with this. If the asking price is this and you offer this, this is how much over you did. Where's it going to appraise? So I put an appraisal column for him, and he could fill out this appraisal number, and then it tells him what his gap is if it appraises at that. Your offer price and the appraisal number. And I just said, you need to look at this and you need to monkey with this until you feel comfortable that you have the resources to cover any worst case scenario.
Mm-hmm.
I'm not going to give you a number. I'm not going to say, oh, you're fine. I'm going to give you a worksheet and go, I want you to understand this.
Yeah. Yeah.
You're the one writing the check.
Yeah.
You're the one that's going to assume the risk. Now, even though you got an appraisal waiver, you can still get out of it. You'll just lose your earnest money.
Mm-hmm. Yeah.
So you can still say, well, am I going to pony up 50K or am I going to lose my 5K earnest money? You can. It's ugly. People don't like it, but it's done.
And like you said, I think people just have to, we're not in a good, it's a tough situation if you're looking to buy a home. And I think people just have to, nothing ever lasts forever, but I think, people say, well, we're going to see a crash. Like you said, when I say nothing's going to last forever, maybe we do, when things start getting tapped down a little bit, maybe, like I said, these investors that have these rental homes, maybe they loosen up a little bit. Maybe once COVID really gets tightened up, maybe the seniors will start selling and going into a senior home. There's a lot of stuff. It's just, everything came together. It's just making
nationally, we have nationally in February numbers, we have a 10.6% decline in pending listings, people actually buying homes. But I think that's a very skewed number because, you've got 10% less homes on the market in February this year than last year. But February last year, there were more homes to choose from.
Yeah.
And we've got a 6% decline, I think, in Arizona in buyer traffic right now. And I think that's the same thing. It's like, I can't find a house.
Yeah.
I'll sit on my hands for a while.
Yeah. I had two people last week say, I'm going to sit tight for a while. they're just burnt. They want to buy a home, but they're just burnt out from going to 20 different homes and putting an offer on and getting pushed. It's just, if I was in their shoes, I'd be the same way.
Yeah, there wasn't a home I showed last week where there wasn't a car already waiting in the driveway and someone pulled in right after I left. You're just standing outside with your MLS listing in your hand, and the phone to unlock the door. But except for, and I'm a broken record on this, the over 55 communities, I'm not seeing it. I'm still seeing an inventory shortage there. Don't get me wrong, but I'm not seeing people lined up waiting to see the house.
Yeah, because it's the seller. The seller doesn't want to have a circus going on. They want to list it for 360 if they got money in the bank. Like we said, they list the house for 360. If they get 360, 365, they're going to be happier than a bird in a tree. So, but
we wrote one sight unseen just to get one of the first offers in this week, and we can't even get in and see it till tomorrow at an open house.
Yeah. And
they're having an open house Saturday and Sunday, and they said they're not reviewing offers until Tuesday. So we turned it in, and and I told the agent, I go, it's everything they're looking for. They know it's got the neighborhood they want. It's the house, and she's going to come by and check it at the open house on Saturday. And I said, and he's a veteran, and he said, great, the seller's a veteran too. So we're hoping, fingers crossed, that this one goes through, because the poor guy's been beat out so many times. It just gets frustrated because I can't estimate what a house is going to go for on the open market anymore. But I keep my ear close to the ground and as much reading as I can so that I can help understand some of the creative solutions that are going on in this market.
Yeah, and if I see anything out, I mean, there's some things I'll bring that up next week if I see anything that pops up, because you and I dig for information, and I'm an information guy. I try to dig for more information, but just real quickly on the rate. I mean, rates have kind of we have this 2-month, up. Rates are going from January 28th or no January 27th, 28th. They just they went up, and we didn't see any. But it was 2 months. You look at a chart, it always seems like something. If we get a crappy crappy time frame like this where rates are getting beaten down or beaten up, I mean, it's usually about 2 months. Sure enough, I look at 2 months, and sure enough, March 30th, rates kind of loosened up a little bit. In the last, they've come down the last week and a half, back around. We touched 175, 173, 174 range on the 10-year, but now we're in the 161, I think it was 162.3 range, 164. So they've come down. But rates, have come down a little bit. I mean, it doesn't mean rates. When I say rates, it could be, back about a week and a half ago, 3% was basically a cost of a couple of $1,000s. Now 3% is a par rate. So rates have come down, but it's more or less the cost that's involved with the rate. So,
I'm also seeing it doesn't look like the markets believe that the stimulus proposals are going to spur on the economy as much as they think it is.
Yeah.
And that's why the bond market has not tanked, right?
Yeah. And the issue, I think, they pulled back on that trillion, the stimulus, but I think the market saw what they did last year with the stimulus. It pumped it up for a couple months, but then we're coming, things were starting to slow down a little bit more, because the realization. I'm just always amazed when they come out with unemployment numbers. They say this, because the unemployment numbers are just a survey. They just call. It's not an exact science. They call 60. I think it's 60,000 homeowners and see if they call 60,000 people and see if they're working or not. That's basically that's the unemployment. How they really figure the numbers. They do a phone survey. So
and
I think
is job growth just ADP payroll? Is that?
What's that?
How do they measure job growth? Just payroll? ADP?
Yeah, payroll. Yeah, ADP. But the unemployment rate really is basically just a survey, house survey. So, but rates have loosened up. Given a little. I mean, nothing crazy, but I think the next couple months you're going to see. You see lumber going through the roof. You see things. I think if things open up, we're going to see inflation. The Feds are going to talk about inflation next week. Their numbers are coming out. So we might see some activity in the market next week. So, but hey, I want to give people a credit tip. I ran into this. If people are looking to buy, if they are looking seriously to buy in the next 2 to 5 months, take a look at if you're looking to get pre-qualified somewhere. Take a look at your credit card balances. And I had one recently where a gentleman, his score would have been about 20 or 30 points higher, but he was butted up against his credit limit on a $3,000 or $4,000 credit card on a couple of them. And he could easily have paid those down a month or two prior to qualifying, and his score probably would have been another 20 or 30 points higher. So if you're looking, if you're out there looking for a house in the next 2 to 3, 4, 5, 6 months, and you've got that one credit card that you owe, it's a balance of $500, and it's a credit limits of $500, or if $1,000 card, pay that down before you get your credit pulled, because anytime you're butt up against the credit limit on any card, whether it's a $500 limit or a $10,000 limit, it's going to have an effect on your score of 15, 20, 30 points. So it could take you from, it'd probably save you, to be a 740 score versus a 719 is going to probably mean $2,000 or $3,000, $4,000 in your cost of your loan. So if you're looking at buying the next 6 months, get those, cards loosened up off your credit limits before you have your credit pulled. So I just thought I'd mention that real quick.
That's a good pin. They want it to be between 10 and 30%, don't they? Don't they consider that kind of the benchmark?
Yeah, I mean, just even like you said, if you owe 1,000, a lot of people think, oh, it's a small credit card. It doesn't hurt it doesn't matter if it's a $500 credit limit or 1,000 or 10,000. If you're butted up against that limit, it's going to hurt your score. And it could help you by 10 or 15 points, but that could be the difference of a couple of $1,000s when trying to get pre-qualified on a loan.
Yeah. Yeah. I noticed I got a loan. I bought a truck and my credit score went down 5 points, even though the financed amount on the truck was the same as the amount that I paid off on my car. So that math didn't change. It's the fact that I had a hard inquiry on an auto loan.
Yeah.
And it blink down 5. I go, okay.
Yeah.
So
I just want to mention that because people, they start looking. I mean, I run in a scenario like I pull the credit report. I'm like, you got 3 credit cards. You're up against your limit. You got a good, decent score. It's 735 or I've had some cases where people were like a 710, but they could have been a 730 or 740. And that makes a dramatic difference when pricing out a loan.
Yeah.
So if you're in the future looking to working those credit cards, paid down, like you said, 10, 20, 30% utilization rate, but just get some of those balances paid down off some of the cards.
That's a good tip. And along with this tough market, when you're feeling discouraged and everything, just continue to save because the savings rates have been great for a lot of people, and, keep saving. That opportunity could present itself. There's another survey that came out that said, this is kind of stating the obvious too, that said, new survey shows 1/3 of remote workers may quit if called back to the office full time. I kind of doubt that.
Yeah.
I don't think you're going to quit, but I'll bet you could have done that survey on working from home 10 years ago and people would have still said they want to work from home. I mean, people are trying to avoid the commute, but now people are dug in. They've probably remodeled a portion of their house. They got all the equipment. They got the lights. They're ready for the Zoom calls. And you call them into the office and they're going, no, I don't want to go.
Yeah.
So I think people in a survey are saying they're going to quit, but I don't think they're going to quit.
No. So
be interesting. All right. Well, we have Sam DeGreen from DeGreen Capital Wealth Capital Management coming on Tuesday to give us that flying above the clouds look. So I want to talk to him about the stimulus plan and what they're seeing. And I really want to talk to him about some of these taxes, like you mentioned. It should. Are you guys advising investors to sell now to avoid potential higher tax rates? What are you advising those investors? So
it'd be interesting to get his perspective too, because he probably does have clients that own investment homes. I'm sure it'd be interesting from his perspective to hear what they're saying.
Yeah, absolutely. Well, in the meantime, everybody, don't forget to smash that like button. Thanks for tuning in and have a super weekend.
Take care. Have a good one.